When discussing stocks, the time-weighted and dollar-weighted rates of return are important parameters to consider. A time-weighted rate of return captures the performance of the stock or the overall market as a percentage, regardless of the stock's value at intermediate periods. For example, suppose a stock is worth $100 per share today. After 1 year, the stock is worth $75 per share. After 2 years, it is worth $150 per share. In this scenario, the time-weighted interest rate can be calculated by finding the equivalent annual return over the 2 investment periods using the compound interest formula. Let me show you a quick calculation as to what I mean. The stock was purchased at $100 today, so that's the principal amount. After 1 year, it is $75 per share, but we ignore that since we're only concerned about what happens at the beginning and at the end. The final amount is $150 after 2 years. So we'll say that A is equal to 150. Now the future value formula for compound interest looks like this. We have the future value represented as FV, the principal is represented as PV, or the present value, I represents the interest rate per period, and N represents the total number of periods. So for us to find the time-weighted rate of interest, all we have to do is solve for I. Let's substitute these values into that formula. 150 is the future value. The present value is $100, and that's being multiplied to 1 plus the interest rate which we're looking for, which is the time-weighted rate of interest. And this is being raised to the power of 2 because 2 periods have elapsed. If we solve for I algebraically, we'll have 150 divided by 100 is equal to 1 plus I raised to the power of 2. We square root both sides. That eliminates the square and the square root. And then we bring the 1 over to this side and we find out our value of I. So we have I is equal to the square root of 150 over 100, take away 1. Let's find out what that is. The square root of 150 divided by 100, take away 1, gives us an interest rate of 22.47. And that's a percentage. Therefore, we conclude that the time-weighted rate of return of this particular stock is 22.47% year after year. Now let's look at the dollar-weighted rate of return and see how it compares to this value. You'll find that the dollar-weighted rate of return captures the performance of a particular individual whose final return is a function of when they added or withdrew cash. So this is more of a personalized interest rate versus one that captures the overall stock. For example, suppose now a second investor also purchases 1 share initially at $100. However, this investor will purchase another share for $75 after 1 year. What is the investor's return? Let's look at this on a timeline. So initially, it costs $100, and that's at time 0. After 1 year, where t is equal to 1, another share was added for $75. And then after 2 years, it is $150. Now, unlike before, since 2 shares have been purchased, if this investor were to sell after 2 years, they would have $300. What we have to do to calculate the investor's return as a percentage is we must defer this for 2 years and defer this one for 1 year. So we have the total amount that the investor will earn is equal to the future value of that investment using the future value of compound interest formula, where I is unknown to us, plus the future value of that share 1 year later. Notice that here the exponent will be 1 because it's 1 year later. By solving for I, we will have found the dollar-weighted rate of return. Now, using a bit of algebra, the value of I will equal to roughly 39.61%. Notice that the second calculation is actually a dollar-weighted rate of return, in the sense that it takes into account intermediate periods of when shares were purchased and added to the total investment. It is more of a personalized rate of return versus the first kind showed. I hope you now understand the difference between the two and can use this parameter when discussing stocks. Thank you for watching.